Hey, Alex here again for Chapter 8 of Financial Accounting 201. We are now on Sarbanes-Oxley, Internal Control, and Cash. So, this is the intro. So, controls are a part of your everyday life. At one extreme, laws are used to limit your behavior. For example, speed limits are designed to control your driving for traffic safety. In addition, you are also affected by many non-legal controls. For example, you keep credit card receipts in order to compare your transactions to the monthly credit card statement. Comparing receipts to the monthly statement is a control designed to catch mistakes made by credit card companies. In addition, banks give you a personal identification number, a PIN, as a control against unauthorized access to your cash if you lose your card. So dairies use freshness dating on their milk containers as a control to prevent the purchase or sale of soured milk. As you can see, you use and encounter controls every day. Controls are just part of life. Just as there are many examples of controls throughout society, businesses must also implement controls to help guide the behavior of their managers, employees, and customers. For example, eBay maintains an internet-based marketplace for the sale of goods and services. Using eBay's online platform, buyers and sellers can browse, buy, and sell a wide variety of items, including antiques and used cars. However, in order to maintain the integrity and trust of its buyers and sellers, eBay must have controls to ensure that buyers pay for their items and sellers don't misrepresent their items or fail to deliver sales. One such control eBay uses is a feedback form that establishes buyer and seller reputations. A prospective buyer or seller can view the member's reputation and feedback comments before completing a transaction. Dishonest or unfair trading can lead to a negative reputation and can even result in suspension or cancellation of the member's ability to trade on eBay. This chapter discusses controls that can be included in accounting systems to provide reasonable assurance that the financial statements are reliable. Controls to discover and prevent errors to a bank account are also discussed. So this chapter is just about controlling the procedures of a business, accounting procedures, cash, internal controls. This is a very good chapter. Not a whole lot of homework on this one per se. More just a lot of theory, a lot of info. So okay, we'll start with the Sarbanes-Oxley Act of 2002. So during the financial scandals of the early 2000s, stockholders, creditors, and other investors lost billions of dollars. And that was before the Sarbanes-Oxley Act. Companies had very little internal controls, so you could do a lot of fraud, a lot of theft. And basically the companies like Enron, Tyco, WorldCom, they didn't have very good controls or measures to keep track of things. So that's why we had that big crisis. That's why Sarbanes-Oxley, this act, basically emphasizes the importance of internal control. So an internal control is defined as the procedures and process used by a company to safeguard its assets, process information accurately, and ensure compliance with laws and regulations. So basically, before we had that, it was easy to commit fraud and theft. And then investors, stockholders, and creditors would bear the burden of those people that would do that. But after the Sarbanes-Oxley Act, stricter, more effective internal controls, less theft, less fraud, investors, stockholders, and creditors are safer. People are more willing to invest. So Sarbanes-Oxley also requires companies and their independent accountants to report on the effectiveness of the company's internal controls. So now, not only do you have to keep a track of your internal controls and follow them, but you also have to have an auditor report on if you're doing the proper procedures, and they're gonna and an auditor would say, I feel as though, in my opinion, they have followed the proper procedures of internal controls. If not, they could say something like, their internal controls are lacking. I feel as though they need more control over the handling of cash or what have you, inventory, whatever. But now there's auditors, managers are going to have to report more on their controls. You can't just leave the keys out for the safe now. Now you got to lock those keys up. So very important. Now, here are the objectives of internal controls. You want to safeguard assets, so keep your cash locked away, keep your assets behind in storerooms. Make sure your financial statements and your books are accurate. Make sure there's not, numbers are inflated or misrepresented. And make sure everything is in compliance with laws and regulations. So make sure you're using the proper GAAP, the proper accounting procedures for the account or asset, whatever you're working with per se. So these are all supposed to help prevent fraud, misuse, or misplacement. Employee fraud is the intentional act of deceiving an employer for personal gain. Such fraud may range from minor overstating of a travel expense to stealing millions of dollars. So fraud can be really minor, like, oh, this travel expense, I need this $1,000 was for travel, but really maybe only $200 was for travel, $800 was for gambling. But they can go up to millions. And in the case of Enron, Bernie Madoff, all those guys, billions a lot of times. There's 5 elements of internal control. So there's 3 internal control objectives, but there's 5 elements of them. These 5 elements are control environment, risk assessment, control procedures, monitoring, and information and communication. So basically the way they explained it here is it's like an umbrella. Environment, control environment, risk assessment, control procedures, and monitoring are the umbrella material, and the information and communications the handle, and then management's underneath the umbrella, and so is the business. So you want to protect your you want to protect everything with proper controls. So the control environment is the overall attitude of management and employees about the importance of controls. So this breaks down into management's philosophy and operating style, the company's organizational structure, the company's personnel policies. Basically, management's philosophy and operating style relates to whether management emphasizes the importance of internal controls. So if managers are following proper procedures and controls, then it's going to help keep employees and the likes also in proper controls. But if they're overemphasizing goals and they like going and deviating from control procedures, it makes an ineffective control environment. Business's organizational structure is the framework for planning and controlling operations. So basically, an example would be a retail store chain might organize each of its stores as separate business units, and then each store manager has full authority over pricing and other operating activities. That way, it's a good structure because each store manager has the responsibility for establishing a control environment. So you're breaking down the framework into more easily controlled parts of the business. Very important. It's hard to control a large business all at once, but if you break it down, it's easier. The business's personal policies involve hiring, training, evaluation, compensation, and promotion of employees. So it's good to have personal policies in place because you really want to hire only competent, honest employees. And that's why internal controls help make sure that employees stay honest and competent, because that way they're on the right track. They're not going off the wall. And then the other one is risk assessment. So a lot of times businesses face many risks in customer requirements, competitive threats, regulatory changes in economic factors. So Management should identify such risks and analyze their significance, it's a hard word, and assess their likelihood of occurring and take any necessary actions to minimize them. Control procedures provide reasonable assurance that business goals will be achieved, including the prevention of fraud. So make sure you have, and this breaks down into four ways to do it. So make sure you have competent personnel, rotating duties, mandatory vacation. So cases of employee fraud are often discovered when a long-term employee who never took vacations missed work because of an illness or another unavoidable reason. So a lot of times fraud is discovered because someone doesn't take vacation ever, so no one ever fills in for them. So when they do finally get sick or can't make it to work, someone fills in, they say, oh, wait a minute, John's been committing fraud for the last 5 years. And so that's why it's good to have, that's why we have mandatory vacation. Just to check on you, make sure you're not doing anything suspicious or trying to cover stuff up, making sure you're staying the way you're supposed to be doing. Separating responsibilities for related operations. If the same person orders supplies, verifies the receipt of supplies, and pays the supplier, you can have abuse. Because if one person is doing all three things, they could be stealing supplies. The accuracy and validity of the invoices may not be verified. So hence they may be forging invoices, like paying themselves for the supplies. They may not have the right quantity of supplies ordered, or the supplies are bad quality. You always want to separate those duties. So one person orders, one person verifies that we got the order, and another pays the supplier. That way you've separated duties. So less error, less chance for fraud. Separating operations, custody of assets, accounting. So employees who handle cash receipts should not also record cash receipts in the accounting record. So the person who's doing the accounting for the cash receipts should not be the one who handles the cash receipts, because you could really start making stuff up, like pocketing the cash and saying nothing happened on the accounting statement. So that's why you want to have more separation. Proofs and security measures. Proofs involve procedures such as authorization, approval, and reconciliation. For example, an employee planning to travel on a company business may be required to complete a travel request form for a manager's authorization and approval. So, and another way is safeguarding pre-numbered documents helps prevent fraudulent transactions from being recorded. Because if you leave out your checkbook, if you're a business and you leave out your checkbook, someone could come up and say, I'm going to write a check to myself saying, oh, this is for so-and-so, and just, you have no control if you leave all your documents out. You want to make sure the person who is writing the check gets authorization from someone else. You always want to have another person making sure to see what's going on. No one should have complete power in those decision making. And then reconciliations are important to make sure if any errors are spotted to fix them. Security measures involve safeguard assets, so cash on hand you keep in the register or the safe. Monitoring the internal control system is used to locate weaknesses and improve controls. So you want to make sure you go and evaluate your internal controls. There's limitations to internal controls, the human elements of control. So human errors can occur because of fatigue, carelessness, and confusion or misjudgment. And also cost-benefit considerations, because for example, sometimes it's not worth the price. For example, retail stores can eliminate shoplifting by searching all customers before they leave the store. However, such a control procedure would upset customers and result in loss of sales. Instead, retailers use cameras or signs saying, "We prosecute all shoplifters." A great deterrent. So businesses usually use banks, more than one bank account, because certain times they might have one bank account for payroll, one for cash receipts. That way it separates what's going on. Great procedure. When you're dealing with cash shortage and overages, so when you have a register, if the register says you should have 35,690, but it only has 35,668, that $22 difference is a loss. You're short. So you're going to debit the cash short and over for that difference. So your sales would be for the full 35,690. The cash would be for the 35,668, and the difference would be a debit to the cash short and over for 22. So cash debited, cash short and over debited, sales credited. And then, of course, we have the bank reconciliation. And the bank reconciliation, you always start with the cash balance according to the bank. Then you add in deposits not recorded by the bank. So deposits in transit. Then you deduct outstanding checks that have not been paid by the bank, so any outstanding checks. Then you do your company section of the reconciliation. So you start with the cash balance according to the company. You add credit memos that have not been recorded. So identify any bank credit memos. Example would be a note receivable and interest that the bank collected for you. You'd add that in. Deduct any debit memos that have not been recorded. So identify any debit memos. Examples would be customers' non-sufficient funds, any NSF checks or bank service charges, so ones you wouldn't have known about. Determine the adjusted balance by adding in the differences, subtracting the differences, and verify that the adjusted balances meet. So make sure the bank meets your company books and the company books meets the bank's. And then you would have special purpose cash fund is a petty cash fund. A petty cash fund is for use for small purchases. So instead of writing a check for every little purchase, like, oh, I need to go out, if you're at a job, I need to go buy more stamps, I need to go buy more pens. Instead of writing a check for every single thing, you might just have a $100 cash fund or whatever you have. And to establish it, you would debit petty cash for the amount, let's say 500, and you'd credit cash for 500. Then, every time, you use the petty cash fund, you put the receipt back in. So at the end of the period, if you know you used $467 of it, you're going to debit each expense account that you used it for. So office supplies, store supplies, miscellaneous, administration expense, and then you'd credit cash. So, and then on the memo note, you'd say restocked petty cash fund. So instead of touching the petty cash fund after you've established it, you would just expense out cash like you normally would, and just say it's from the petty cash, because you're going to refill the petty cash every period. And then to wrap it up, we have the ratio of cash to monthly cash expenses, which you take cash as of year end divided by the monthly cash expense. And the monthly cash expense is found out by the negative cash flow from operations divided by 12. So here we have an example of Evergreen Solar Incorporated, manufactures solar products. So they had, in 2009, they had $112,368 in cash and cash equivalents. So they divided that by the monthly cash expense, which would be the $37,094, and that would give you the monthly cash expense of $3,091. And then if you take that, that would give you the 36.4 months of, so that's basically, that ratio tells you if they have to stop, if they only had the cash they had at that moment, how many months could they go on just using the cash they have. And so you can see how many months forward they could go. Alright, that's it for, this was just pretty much not a lot of entries, more of just internal controls, cash, the Sarbanes-Oxley Act. Nothing too off the wall. Once again, I will go back, I could do some examples later on, but just wanted to discuss it a little bit. And if you have any questions, feel free to leave any comments, and maybe I could help or answer any. So, thank you very much, and I'll see you for Chapter 9.